I'm Cynthia Rowland, and this is episode 108 of EO Radio Show. Today's episode is the second in a series of technical episodes describing the basic principles of the tax on unrelated business income generated by organizations described in Internal Revenue Code Section 501c3. As most listeners are probably aware, 501c3 organizations, that is, public charities and private foundations, are exempt from income tax generally. But this does not mean that all income generated by the organization is tax-free. For most organizations, unrelated business income is income from a trade or business regularly carried on that is not substantially related to the charitable, educational, or other purpose that is the basis of the organization's exemption. In episode 107, I went over these defined terms and provided a number of good examples. And in this episode, we'll explore the modifications to unrelated business taxable income that provide exceptions to income items that would otherwise fall into these definitions that are taxable, but instead are categorically excluded because generally they constitute passive income. In the next episode in this series, I'll cover the exception to the exceptions for income that is debt financed and thus generally taxable. Welcome to the EO Radio Show, your nonprofit legal resource. Brought to you by the Exempt Organizations Group at Farella, Braun & Martel. My name is Cynthia Rowland, and I'm a partner at Farella. I'm a business and tax lawyer with more than 30 years of experience advising clients on nonprofit and charity law. Through this podcast, our lawyers and guests will discuss a range of legal and business issues impacting the nonprofit world because we understand you work hard every day to make your community a better place to live and do business. Many of our programs focus on the basics, and at times we'll do a deep dive into narrow and complicated legal issues. Again, welcome to the EO Radio Show. We're glad you're here. So today I'm going to talk about the modifications and exceptions to unrelated business taxable income for public charities and private foundations, that is, organizations that are described in Internal Revenue Code Section 501c3. As a reminder, listeners that want comprehensive details about UBIT should start with IRS Publication 598, which has detailed information from the IRS regarding the tax on unrelated business income for charities and for all other sorts of exempt organizations. To recap, in the last episode, I talked about unrelated business taxable income generally, and we note that it is an issue when a charitable organization has income from a regularly carried on trade or business that is not substantially related to the charitable, educational, or other purpose that is the basis for the organization's exempt status under 501c3. As with the last episode, I'm only going to talk about federal income tax issues and only for 501c3s. Be sure to check state law for state income and state property tax implications of operating an unrelated trade or business. So also to recap, what's a trade or business? The term trade or business generally includes any activity carried on for the production of income from selling goods or performing services. Activities of producing or distributing goods or performing services from which gross income is derived do not lose their identity as a trade or business merely because they are carried on within a larger framework of other activities of the exempt organization that may or may not be related to the organization's exempt purposes. Regularly carried on, that's a phrase that's key to the definition of unrelated business taxable income. Business activities of an exempt organization are ordinarily considered regularly carried on if they show a frequency and continuity and are pursued in a manner similar to comparable commercial activities of taxable organizations. The next part of the definition is that the taxable income is not substantially related to the charitable, educational, or other purpose that is the basis of the organization's exemption. To determine if a business activity is substantially related to the exempt function requires an examination of the relationship between the activities that generate the income and the accomplishment of the organization's exempt purpose. A trade or business is related to exempt purposes in the statutory sense only when the conduct of the business activities has a causal relationship to achieving the exempt purposes. Note that this does not include producing income that can be used to provide the services. So, in other words, the production of income is not in itself an exempt purpose. The causal relationship between the activity that generates the income and the exempt purpose must be a substantial relationship. The activities that generate the income must contribute importantly to accomplishing the organization's exempt purposes in order to be substantially related. So now, the main point of this episode. Let's look at the common categories of modifications to the definition of unrelated trade or business. The Internal Revenue Code contains a number of modifications, exclusions, and exceptions to unrelated business income. The most important of these are dividend income from corporations, interest income on invested assets or loaned assets, certain other investment income, royalties, that's an important exception, certain passive rental income, income from certain types of research activities, and gains or losses from the disposition of property. These are all excluded when computing unrelated business income, unless, and we'll get to this in the next episode, unless they're debt financed. So keep that in mind. But if they're not debt financed, those categories of income are not going to be subject to unrelated business income tax. But keep in mind that if these exempt categories of income are earned by a partnership or LLC, there are special rules that require the organization to look all the way through the partnership structures to determine the actual source of income. So investments in partnerships need special scrutiny to determine whether there will be unrelated business income generated by the partnership investment. This comes up because more and more frequently, exempt organizations, public charities, invest through limited liability companies or limited partnerships in investment funds. And if those investment funds are invested in activities that generate what would otherwise be unrelated business taxable income, it's still going to be unrelated for the charity. Now, again, there are many exceptions, so check with your tax return preparer if you're surprised by an allocation of income that is treated as unrelated business income. So let's talk about a few activities that are specifically excluded from the definition of unrelated trade or business. These include volunteer labor. Any trade or business income is excluded if substantially all of the work is performed for the organization without compensation. So some fundraising activities, such as volunteer-operated bake sales, may meet this exception. There are also exceptions for income earned for the convenience of the members. A trade or business is excluded if it's carried on by an organization described in 501c3 or a governmental college or university, a similar category, primarily for the convenience of its members, students, patients, officers, or employees. An example of this is a school cafeteria. Another important exclusion is sales income from donated merchandise. A trade or business is excluded if it consists of selling only merchandise, substantially all of which the organization receives as gifts or contributions. Many thrift shop operations of exempt organizations would meet this exception. Another important exception is income from qualified sponsorship payments. A qualified sponsorship payment is any payment received by a 501c3 that is made to it by a payor who's engaged in a trade or business, for which that payor will receive no substantial benefit other than the use or acknowledgement of the business name, logo, or product lines in connection with the organization's activities. The phrase use or acknowledgement doesn't include advertising the sponsor's products or services. An example of a qualified sponsorship payment might help. For example, in return for receiving a sponsorship payment, suppose an organization promises to use the sponsor's name or logo in acknowledging the sponsor's support for an educational or fundraising event. That sort of payment is a qualified sponsorship payment and isn't treated as unrelated business income to the charity that receives it. Providing facilities, services, or other privileges, for example, complimentary tickets or spots in a golf tournament or receptions for major donors to the sponsor or the sponsor's designees in connection with the sponsorship payment, doesn't generally affect whether the payment is a qualified sponsorship payment. Instead, providing these goods or services is treated as a separate transaction in determining whether the charity has unrelated business income from the event. So generally, if the services or facilities aren't a substantial benefit to the payor, or if providing them is a related business activity, the payments will not be subject to the unrelated business income tax. Let's contrast a qualified sponsorship payment with advertising income. Advertising income isn't a qualified sponsorship payment and is subject to unrelated business taxable income. So a payment isn't a qualified sponsorship payment if in return the recipient charity advertises the sponsor's payments or services. Advertising includes messages that contain qualitative or comparative language, price information, or other indications of savings or value. Advertising also includes endorsements and inducements to purchase, sell, or use the products or services. The use of promotional logos or slogans that are an established part of the sponsor's identity isn't by itself something that constitutes advertising. In addition, merely distributing or displaying a sponsor's product by the recipient charity to the public at a sponsored event, whether for free or for payment, is considered the use or acknowledgement of the product, and it is not treated as taxable advertising. So there are also some exceptions to this exclusion for qualified sponsorship payments if the amount paid is contingent by contract or otherwise on the level of attendance at the event, the broadcast ratings, or other factors indicating the degree of public exposure at one or more events. However, the fact that a sponsorship payment is contingent on an event actually happening or being broadcast, that doesn't by itself affect whether the payment qualifies. A final point to keep in mind that I want to highlight here for qualified sponsorship payments is that a payment isn't a qualified sponsorship payment if it entitles the payor to the use or acknowledgement of the business name, logo, or product lines in the organization's periodical. For this purpose, a periodical is any regularly scheduled and printed material published by or on behalf of the organization. It doesn't include material that is related to or primarily distributed in connection with a specific event, that is, a program of the event or a brochure distributed at the sponsorship event. So that's all for this episode. Be sure to check out the show notes for links to the resources mentioned today. Also, Farella, Braun & Martel has a YouTube channel, and the nonprofit playlists for the EO Radio Show podcast organize all the past episodes to make it easy to find information on topics relevant to you. I'm Cynthia Rowland, and you've been listening to EO Radio Show, your nonprofit legal resource, brought to you by the Exempt Organizations Group at Farella, Braun & Martel. If you have suggestions for topics that you would like for us to discuss, please email us at eoradioshow@fbm.com. That's eoradioshow@fbm.com. Thank you for joining us. Until next time, make a difference.